Hello and welcome everyone to Pareto Spring Statement 2025 podcast. I'm Stuart Carswell from Pareto Financial Planning, and today we'll be discussing the key takeaways from the Chancellor's latest spring statement and what this means for both individuals and businesses. To discuss this, I'm joined with two expert guests. Firstly, we have Alex Binnington, Financial Advisor from Pareto Financial Planning. Alex will be sharing his insights from the financial advisor's perspective, highlighting how changes can impact personal finances, tax planning and pension strategies. We're also joined by Alex Brandreth, Chief Investment Officer at Lunar Investment Management. Alex will provide his perspective on how the budget might influence markets, investments and the broader economic landscape. So, Alex Binnington, what are your key takeaways from the spring statement?
Well, as anticipated, there weren't any new tax measures this time round. They were dealt with in the main budget. But the statement was more of an update on the public finances, supported by the OBR, the Office of Budget Responsibility, ahead of a full spending review in June. And that really continues the government's promise to hold just one fiscal event each year, which they've stood by.
Yep.
So the key takeaways as I see them are that whilst there are no new tax increases being introduced, the government is considering reforms to ISAs to better balance cash and equity investments. And I think that initiative really aims to enhance returns for savers and support a culture of retail investment, and that will potentially affect clients' saving strategies. With regards to national insurance contributions, there will be an increase of the employer national insurance contributions from 13.8% to 15%, but there will be a reduction in the threshold employer starting incomes from 9,100 to 5,000. But there will be an increase in the national minimum wage, and that will impact on company profits going forward.
Okay, and Alex, thank you for that. And Alex Brandreth, how do you think the announcements that were in the spring statement just runs through some of those and how it may affect clients?
Yeah, so the main thing that was announced was the Office of Budget Responsibility, OBR, came through with revised growth forecasts and they came up with inflationary changes. So the big announcement from the OBR is that GDP growth for this year is being reduced from 2% to 1%. Shouldn't really be a surprise, I don't think. The economy's not really started this year very well. The GDP announcement in January was that the economy actually contracted by 0.1%. So they were very much expecting that the UK economy will accelerate as we go into the second half of the year. And one of the factors behind that is what Alex said, it's to do with the increase in national insurance, and that's really had an impact on business sentiment within the UK. So that was the key one for me. They did also revise up future years' growth as well to 1.6 to 1.9% to the end of Parliament. And that was on the back of 1.3 million new homes being built due to planning reforms which are coming through. So I do think that's a positive that you're going to see stronger growth in future years. I do think that might be slightly ambitious though, in that I think the UK economy really at the moment, given the state that we're in, is probably about 1% growth is what should expect. So it'd be interesting to see if the next budget then you see growth revised for future years again. But let's wait and see.
Okay, good, thank you. And you mentioned about house building. Do you want to just touch on interest rates and where they think they may be going forward?
Yeah, so we've already had 3 interest rate cuts in the UK. We started at 5.25, we're down at 4.5, so 3 quarter point cuts. I'm expecting probably 2 more this year, and the likely timing of them will be May, August and November, because there's quarterly reports that the Bank of England put together, and the last one was in February, which is the last interest rate cut that we saw. But we're sort of expecting that interest rates will probably end up around 3%. And that's important because, as you touched on, that's going to impact borrowing costs for companies, but for all of us, it impacts our mortgage costs as well and how much we're paying. So, hopefully some good news out there that mortgages will be coming down. But ultimately, this will be dependent on what's going on with the economy at the time. If we come into a global recession or something like that, which is not something we're forecasting, but you could see interest rates come down quicker than that.
So it seems that the government's trying to balance the books as much as it possibly can do. Do you just want to run through what the impact may be on clients' portfolios and markets in general, Alex?
Yeah, so there's not been really any big impact from the budget in terms of markets. It was all flagged very much beforehand. So sterling's been quite stable. The gilt market has sold off this year, but I don't think that's to do with the UK government. I actually think that's more to do with the US government and some of Trump's policies, which has seen global bond yields pick up, and the cost of borrowing going up is one of the reasons why we lost this fiscal headroom. And the equity market has actually been the UK equity market's been quite strong. What's really been driving markets this year is Trump's policies. Tariffs are inflationary, they're going to cause problems to supply chain. And I think you've really added a bit of uncertainty into US businesses because of this, because you can't plan because they're announced and then they're withdrawn with almost in the day. Quite entertaining, really, isn't it? So that's what's been driving markets this year. And I think that's what we'll continue to do. So I think this is going to carry on maybe for 6 to 9 more months, but at some point towards the end of the year, you've got to think that Trump's policies are going to start to be focusing on the midterm elections and maybe being as less controversial. Stop bringing out all your dead right at the beginning kind of thing. So we are optimistic that, and there are a lot of policies that Trump's been coming through which are positive for markets, whether that be ending the war in Ukraine, that will bring down gas prices, which is increased profitability for European businesses. But cutting taxes is the one that was mentioned when he was coming in elected, and we haven't seen that yet. So that would be a positive for US companies as well.
Great, thank you. So there's a lot in there with regards to spending and, dare we say, austerity, as mentioned before. And there wasn't much in the spring statement with regards to financial planning, Alex. But in the autumn budget last year, there was quite a lot that Rachel Reeves announced that is going to impact some of our clients going forward. So do you just want to discuss some of those important changes and the considerations for our listeners that they may wish to think about?
Yeah, of course. In the autumn budget last year, there were significant changes to inheritance tax that were announced, and they are of concern to clients. Things like pensions were previously not considered part of your estate for IHT, meaning that they could usually be passed on free of inheritance tax. However, from April 27, it's been said that pensions will form part of a person's estate and be subject to IHT. So that's a major change to people's planning. Something else that's effective from April 2026, the government will restrict inheritance tax reliefs available for agricultural assets and some other business assets that may qualify for business relief. And some of the value of those businesses and agricultural assets will be subject to 50% of inheritance tax. The specifics of those restrictions are yet to be fully detailed, but they are expected to impact estate planning for owners of those assets. A new tax-free threshold of £1 million has been established for estates. Amounts exceeding that threshold will be subject to inheritance tax with a 50% relief, which effectively results in a 20% tax rate on the excess. And that adjustment aims to provide relief to larger estates by reducing the effective tax rate above that £1 million threshold. So these reforms underscore the importance of estate planning. Individuals with significant assets, particularly those with pensions, business properties, agricultural land, should take advice from one of our financial advisors to understand the implications of those changes and explore strategies that could mitigate potential IHT liabilities.
Great, thank you. And I would like to stress there are things that we are doing with our existing clients right now that are helping them alleviate those concerns about inheritance tax going forward. That brings us to the end of our discussions for the Spring Statement 2025 podcast. Alex Binnington, thank you for sharing your insights from a financial advisor's perspective. Alex Brandreth, for your expert analysis on the market and investments implications. We hope you found this discussion valuable. We'd like to thank you all for listening and stress if you do wish for any advice or reviews, feel free to speak to your financial advisor or come through to myself or Alex. This podcast is part of a series we have recorded, so please make sure you subscribe and check out our other podcasts that are available online. As always, the information provided in these podcasts are general in nature. These shouldn't be relied upon without seeking professional financial advice. If you would like to speak to someone regarding your personal circumstances, please feel free to get in touch with us. Thank you for your time.